Transmedics really has revolutionized the organ procurement or organ donation process in the United States. It has grown the overall market and it owns over a quarter of it in heart, lung, and liver. But the company reported earnings after the market closed today, and it really did not like what it heard. So what does this mean for shareholders moving forward? My name is Brian Stoffel. We'll spend the next couple of minutes trying to figure this out. As of the time of this recording, I do own shares of Transmedics, and I want to give a shout out to Fiscal AI for sponsoring today's video. So this was Transmedics' first quarter 2026. Depending on what happens between now and when the market opens tomorrow, it'll be anywhere between a $2.5 and a $3 billion company. Now, headline numbers first. Revenue came in at $174 million. That did miss analyst estimates, but just slightly. Management only guides for full year revenue because it can be choppy. Overall, revenue is up 21%. Earnings per share. This is where the misses really start to come in. Excuse me. Earnings per share of 30 cents was down a bunch from last year. That's not that big of a deal because they were artificially high because of a one-time benefit, but they were half of what analysts were expecting. If we look at margins, the picture does not get any better. Gross margins were down. It's alarming. Operating margins were down by a lot. Worth noting. Net margins down by a lot. Free cash flow did improve. The company is building out a new headquarters, so there are losses in the first quarter, but they did improve while net income was down. And the balance sheet is about break even between cash and long-term debt. Let's go through each one of these pieces to see what's going on. So total revenue was up 21%. But we got to remember there's two parts to this. The first part is the product revenue, the machines and the consumables that keeps heart, lungs, and livers alive for longer. That's worth noting that was actually up 23%. Service revenue was only up 20%. That is the cost of transporting these organs on the company's 22 owned aircraft across the United States and having a service professional on board with them. That was only up 20%. So that was the mixed 21% growth. Now the cost of revenue was up 32%. That's really bad. But we should look at how this plays out across the two different product lines. So first, let's take a look at product revenue. All right. Gross margins for the products, those machines and the consumables that keep the organs alive for longer. Those were actually down from 81.5% to 77.5%. Now, that could look bad, but that's on a year-over-year basis, and it is worth pointing out there are some different moving pieces here. One of those moving pieces that I'd be curious about, but I haven't heard about from management or any analysts asking the questions, is this. Transmedics is willing to cover the cost of an organ that fails while using their systems. That's one of the reasons that hospitals and organ procurement organizations, or OPOs, are willing to use Transmedics. It is possible that whether through their fault or just bad luck during a quarter, that more of those organs failed, and so their warranty had to cover those costs. Now, I don't know that, but I know that that's a possibility. But overall, I do want to point this out. That 81.5 to 77.5, that is alarming. But it is worth pointing out that on a sequential basis, it actually was in the high 70s for Q2, Q3, Q4 of last year, and in fact, took a step up from 76.7% to 77.5% quarter over quarter. So take that for what it is. Now, on the service revenue, we saw significant that's like a 10% drop in the company's margin percentage, going from 29.5 to 26.5. It's 300 basis points. And when management was asked whether or not rising fuel costs because of what's happening in the Middle East were being passed on, management, to be perfectly honest, they obfuscated. They said that they can't release those details to us, and that they were doing right by their customers, which sounds good, but it means that at least 100% of those weren't being passed on. Now, of course, that's not that big of a deal if fuel costs do eventually come down, but if they don't, that could be a problem. Overall, that's why gross profit only grew 15%, even though revenue grew 21%. On operating expenses, there was a whole bunch of increases here. Now, this might be alarming, but it is worth pointing out that it's not surprising. Here's why it's not surprising. Number one, the company's main organ is the liver. but it is working hard to get approval for kidney, which it expects to submit for kidney approval to the FDA in 2027, and ongoing trials to improve adoption of their machine for heart. Those are through the enhanced trials, and lung through the de novo trials. And obviously, that is going to up R&D costs. Also, the company is expanding in Europe, which has some G&A and some selling costs associated with that as well. They are actively looking and actively building out their presence in Italy, and they signed a agreement to partner with PAD Aviation in Germany. So that's not that surprising. Now, it is worth pointing out one other thing, which I think was very interesting that came out in the conference call, and it is this. For those heart trials, so they have a new version of their heart machine that they believe will be more effective than anything else that's out there. But in order to prove its efficacy, when it runs its trials, it needs to be run versus some type of control group, cold storage. The problem is that the cold storage companies, according to Transmedics, were so worried about this possible solution that they wouldn't allow their devices to be used in the trials. So what Transmedics did was come up with their own cold storage device. And so that cold storage device, controlled hypothermic organ preservation systems, or CHOPS, is two things at once. It's kind of a middle finger to the rest of the industry, to be honest with you, but it's two things at once. One, it provides a control to prove the efficacy of their warm perfusion solution for hearts in trials. And two, it offers a solution that could now be used in place of the cold storage solutions that are used writ large. And on the call, the company's CEO said 46% of heart transplants are cold storage. So this CHOP solution could go after that portion while still being able to help grow the warm perfusion market. Now, we don't know how that's going to turn out, but it was an interesting development that they talked about on the conference call. Now, the combination of these two things, I would say the gross margins for the product, I would say, are largely stable, even though they're down year over year. Again, if you just zoom out a little bit more, the product revenue margins were about the same. It's that service revenue where I believe it is relatively certain they are not passing on all the fuel costs to their customers. That's number one. And number two, the fact that they up their operating expenses by a lot, but that's to be expected because they're trying to get ready for a new lung solution, a new heart solution, a new kidney solution. Of course, those solutions have to come to fruition in order for this to be worth it. That being said, this is why operating income was down by half. They had more interest expense during the quarter, which is not surprising given that they've taken on debt and they have to pay interest on that. And all that combined is why their net income was down 72%. Number of basic shares outstanding was up. A little bit more information, we're going to head on over to Fiscal AI. Now, this is a tool that I think any individual investor that wants to become better at what they do, they should use. I use it every day. Simply click the top link in the show notes below. And if you decide for full functionality and a year-long membership, you will get 15% off by using this link. All right, so what I pulled up over here in Fiscal AI is showing, and this shows the data that was just released a couple hours ago, how the company makes their revenue. Let me break it down for you. This teeny tiny red part at the top, that's from lung transplants. Obviously, this is a very, very small part of the picture. It is why those de novo trials are important. Next is U.S. heart revenue. Now, the combination of the possibility of version 3.0 of the heart transplant warm perfusion plus the CHOPS cold perfusion, it could expand this meaningfully. Heart is definitely the second most important. Liver is obviously the behemoth here, the liver revenue. And this is where you see a lot of benefit from using the machines that keep blood pumping through the liver while it's en route for a transplant. And finally, this is all of those three were U.S. revenue, and this final one is outside of the U.S., all different types. Now, what I want to do is just show you how they're growing. So this tiny purple one right here, not that important, but it is growing 39%, which all things being equal, isn't bad. Right here, this is the lung revenue down 40%, but again, this is so small that I wouldn't read anything into it at all. If we look at the heart revenue, this one is a little bit more interesting. It actually did shrink. I do think that part of this is because the warm perfusion of the device that they have now has kind of matched its market possibility, and the version 3.0 of their warm perfusion device and now this CHOPS alternative is what's needed that could reaccelerate this growth. And finally, the most important by far in today's environment is the liver, and what we see there is that did grow 28%. That is a step down from the growth that we saw before, but still not bad overall. So what else should investors look at moving forward? Well, management only guides for the full year. So this is a full year guidance. And they're still guiding for a midpoint of $742 million, which would be 23% growth year over year. They don't give any earnings guidance. That is ever so slightly ahead of what analysts are expecting. Analysts are expecting about $3 per share, which is about 50% lower than last year. But again, this doesn't mean very much because of the fact that this is a company that had a one-time benefit last year. So next question then becomes, what should we watch moving forward? Well, number one is those gross margins for the product. Remember, they came in at 77.5%. I want to see them being stable in the high 70s. Number two, that full year guidance. They've got to say that they're still going to meet those numbers. And if they need to let us know why. Number three, any commentary on their trial results, whether it's the heart through Enhance, the lung through De Novo, or their kidney, that is very welcome. And number four, operating margins, because we do understand that they're investing for the future, but we have to know that they can do that profitably. Overall, I do think that the Moat direction is stable. It will get wider when they get permission to start using those other things and see adoption ramp up. The thesis is on track, cautiously, assuming that they hit the approvals for those things. So given this outlook where it looks pretty good, but a lot of it hinges on coming up with new products and getting acceptance for that, what about the company's valuation? Well, before I get that, I want to point out that I've been tracking my results versus the S&P 500 way down there in the red and the NASDAQ composite in the yellow for over 10 years. If you'd like to learn how I go about investing, I encourage you to join Stock Investing Mentor, which comes in 3 parts. The first part is live weekly 1-hour training sessions, Thursday at noon Eastern, that are recorded. Number 2, full access to my real-time portfolio. Any moves that I make in my portfolio, you know about that moment and in real time. And number 3, 24/7 access to a private online investing community. However, there is a new part that we are adding to this, and that is Stock Simplifier 2.0. Now, this is a product that is not available to the general public yet. However, by becoming a member of Stock Investing Mentor, you get this for free. This is a $200 to $300 value for free. And let me just show you some of the things that you can do in this. You can analyze the company's moat. So for instance, Stock Simplifier talks about how it thinks that the company does have a wide moat that's widening. It talks about switching costs, network effect, intangibles, and counter positioning. It can also tell you about the growth potential for the company, which you can see in this next slide right here. And it tells you about U.S. liver is still early. The NOP is expanding its revenue base, and so on and so forth. So if you're interested in joining Stock Investing Mentor and getting Stock Simplifier 2.0 for free, simply click the second link in the show notes below, and you'll get 10% off that whole bundle. All right, so let's talk about Transmedics valuation, because I don't think a reverse DCF is actually the most useful thing to use here. I think it really comes down to, let's talk about management's guidance. So in 2025, there's approximately 5,300 transplants that the company did. Now, before then, they had been saying that they would hit 10,000 transplants by the end of 2028. But they upped their guidance to 20 to 30 transplants by the end of 2030. Now, how do they expect to get there? Through the enhanced trials, making hearts to contribute more, the De Novo trial to get lungs to contribute more, and for kidney to contribute significantly more. Those aren't guaranteed, but that's why they upped their guidance. Now, we can build out a TAM analysis here, if we look at this, like we can build a bear case that says by 2030, they only hit 15,000 transplants. They fall short. Our base case can be the low end of guidance. Our bull case can be the high end of guidance. Then we look at the amount of revenue per transplant. Now, right now, the company gets about $110,000 per transplant. In the bear case, we assume that that erodes by over 25%. In the base case, we assume that it erodes by about 15 to 20%. The bull case actually assumes that it erodes by about 10%. So we're assuming that that erodes, and then we get a total revenue number for the company by the end of 2030. If we assume a 25% operating margin is a bear case, the company called out a 30% operating margin as their base case and 33% as the bull case, we get different operating profits. And then we have to slap a multiple on it, times operating profits. Our bear case, it's 12 times operating profit. Our base case, 25. Our bull case, 35. And then we get different market caps. Now today, the market cap is about 2.5 billion. So if they hit their bear case, it'll be up to 3.4 billion, but that's over almost 5 years. So that's not a great return. But if you look at the base case and the bull case, that changes things entirely. What if we blend this and we say, look, there's only a 1% chance of that bull case, and there's a 24% chance of that bear case, and we give them credit, the 75% chance of hitting that base case. Well, if they did those things, then that would give them a market cap of $11.3 billion by the end of 2030. That means from today to 5 years from today, it would go from 2.5 to 11.3, which is a 35% annualized return. Now, do I think that we should absolutely count on this number? No. There's a lot of questions that come into play here. Will they get approvals? Will their technology be leapfrogged between now and then? That said, that's a big number. That's a huge, huge margin of safety for investing in Transmedics. So I think that's worth considering as well. There's a lot of moving pieces here. And because it's a small company in a small market, it can be a lot choppier than bigger companies in bigger markets. But that said, I think that if the company can get the approvals that they're looking for, and if the company can show that those new products are being adopted, then today is going to be a steal of a price to own this company. If they don't get those approvals, well, then all bets are off. So that's where I am in my thinking about Transmedics. Let me know what you were thinking about Transmedics in the comments section below. If you'd like to know what precise moves I might make in the future, join Stock Investing Mentor, run it through Stock Simplifier 2.0 by clicking the second link in the show notes below. And don't forget to hit subscribe for when I go over Transmedics next in 90 days. Until then, Brian.